Thank you for joining me. I'm Alex, and I want to talk about Dollar General. So Dollar General does retail, generally cheap-ish retail, so they're a competitor to Walmart, kind of, Walgreens, definitely, and things like that. Current price $191.38, which gives them market cap of $48 billion. Current dividend yield is 0.75% with a payout ratio of 17%, which obviously is extremely low, but with that payout ratio, they could quintuple the dividend yield to 3.75% and still have money left over. So obviously much room for growth there. They could be raising the dividend yield higher than what Walmart has currently, and that's obviously a good sign. Overall, I wouldn't expect that to increase rapidly, especially during these times, but overall I would say that the dividend is not great, kind of a bonus if everything else looks great. Revenue $27.8 billion, up from $25.6. Earnings $1.7 billion, up from $1.6. Obviously, growth is good. Obviously, also, these are pre-COVID numbers. So, from what I can see, everything is going well for them, and I wouldn't really expect anything different because they're a low-price retailer with lots of food stuff. So, they really shouldn't be affected by any downturn, recession, whatever is going to happen. Current PE of 25, forward PE 24. Again, the estimate was pre-COVID, but obviously a good sign regardless. Total assets $22.8 billion, up from 13.2, which is incredible. Total liabilities 16.1, up from 6.8, which is weird. Total stockholders' equity increased slightly. So overall, don't really like the balance sheet. I think it was far better last year than it is now. Overall, though, growing on both sides is not really terrible. Kind of concerned that stockholders' equity went up far less than the earnings were. And with the payout ratio being completely insignificant, I don't like that, especially during these times. So don't really like the balance sheet, don't really like the dividend, don't really like the PE. So overall, I don't think there's enough growth for a growth investor. I don't think there's enough dividend for a dividend investor. And I think that for a value investor, the PE is quite high. The dividend is almost non-existent. The growth is not really there. So that's what 4-ish% growth. Going to just have to wait and see what happens. But overall, I think that especially during these times, the stock is slightly overvalued, but I don't think it would be a terrible buy for a value investor. I just think that there's better deals out there. So I would probably just go for something else right now, but it's not a terrible stock per se. That's it for me for today. If you like this video, make sure to subscribe. I'm coming out with more videos every day before market open. I hope you have a successful day.